So this session, titled The Future of Global Asset Platforms, Scaling, Strategy and Stewardship, I will be so delighted to welcome all of my distinguished guests today on this panel. And let me start by introducing the panelists from left to right. I'll start with Guy Weldon, the Group Managing Partner and Head of Investment at Bridgepoint Group. Guy represents the scaling strategist, focusing on managing inorganic growth and maintaining cultural autonomy across a multi-product platform of private equity, credit, and infrastructure. Welcome. Jonathan Goldstein, the founder and the CEO of, actually, let me go to David first. David Steinbach, the Global Chief Investment Officer at Hines. David leads a $91.8 billion real estate platform, bringing expertise on the shift from project-based structures, the role of AI and data centers, and the strategic rewiring of a global capital, including the Middle East. Dana Settle, the co-founder and managing partner at Greycroft. Dana Settle brings the perspective of high-velocity, technology-driven innovation, specializing in seed to growth investments across the disruptive startup ecosystem. And last but not least, Jonathan Goldstein, the founder and CEO of Kane International. Jonathan specializes in vertically integrated platform model, linking real estate equity with strategic private equity and high-profile luxury lifestyle brands, offering a unique perspective on brand stewardship. Thank you, everybody, for joining me today. And let me introduce this panel to our beloved audience here. So this panel discusses, as we mentioned, the future of global asset platforms, the scaling, strategy, and stewardship. As investment firms evolve beyond single asset strategies, this conversation will examine how assets and how leaders are integrating technology, operational excellence, and cross-sector capital to build resilient next-generation organizations. And we will specifically explore in this session the critical challenge of balancing global scale with local specialization and what principles of governance and stewardship will actually define the next era of asset leadership. So let's start, and I will start with, so this session is going to be divided into 4 different segments that will tackle each angle of this topic. So we will start with segment 1, which is about scaling and platform growth, and I will start with you, Guy. Bridgepoint has noted the shift to a multi-product platform and the significant challenge of scaling inorganically. What specific cultural or operational hurdles were the most challenging to overcome when integrating asset classes with the fundamentally divergent risk profiles and investment cycles?
Well, Bridgepoint, like a number of other asset managers, has chosen to go down the route of creating a more multi-strategy platform, I think in response to 2 sort of key themes. The first is that a number of our clients want to put more meaningful commitments behind a fewer number of managers. But secondly, they want to do that whilst being thoughtful about having a diversified portfolio and not being over-allocated to any single asset, single geography, single sector, single product. And I think that makes a lot of sense in the context of a world that's sort of more and more volatile, both politically and economically speaking. The backbone of Bridgepoint for the last 40 years has been the middle market and Europe and private equity investing. But in the last few years, we broadened that focus, and 5 years ago moved into credit in Europe by buying EQT's credit business, and then more recently Energy Capital Partners, which is one of the most specialized energy infrastructure managers in the US. They've joined the Bridgepoint family. So today we're probably one of the most active middle market managers across those 3 strategies in Europe and the US. But to address kind of your question head on, I think the key risk of going down this route is that you lose focus on sort of what made you good in the first place, actually. And we're trying to make sure we address that by staying laser focused on middle market. That's where our real expertise is. And in the 4 sectors within middle market, which represent most of our investment activity and where we have the best insights, the strongest relationships, the deepest track record. I think the opportunities, the advantages that we see from going down this strategic route, I mean, they're numerous, but to sort of just talk about 3 or 4 of them. Firstly, I think by being cross-strategy, we get better insights, better market insights, better sector insights, and that should lead to better investment decision-making. Secondly, it means we've just got a bigger investment team on the ground, stronger brand presence overall, and I think that's good for driving deal flow. Thirdly, it gives us the scale to invest in sort of areas of specialist support for the investment teams and for group resources that the individual products can leverage off. And lastly, I think that from a career development point of view, it means that we offer more varied, more exciting career development opportunities for colleagues, and that's got to be good for both recruiting and retaining the best talent in the industry.
Well, great. Let's go to David. So, David, you identified the critical shift from project-based structures to a comprehensive platform-based approach. Operationally, how has this changed, optimized Heinz' massive capital allocation process across 31 countries? And what is the greatest remaining operational friction in managing this globally decentralized yet centrally structured system?
Yeah, so Heinz is we have about just shy of 100 billion under management, like you said, in about 30 countries around the world. So an incredibly distributed talent base around the world. And just to add on, what I see happening right now in the market is it's kind of some interesting dynamics. And I think about it as a barbell at the gym, right? Kind of barbell economics. And I think organizations are going to get forced to either scale or specialize, and the middle is going to get squeezed. So it's like a barbell in a gym. And so, and there's going to be a good business on both ends of the spectrum, but it's going to be tough to be in that middle spot. And so we, as an organization, have chosen to scale and to lean into that side of the barbell. And that presents its own challenges because, especially trying to have an organization with talent all around the world, and real estate, in our world, real estate's a very local business. And so threading that needle is a challenge. I think, though, that unlocking things that are possible only if you can scale are critical to win the hearts and minds of your own employees as you go down that journey. And I think in a world of AI and other elements of technology, they're going to enable insights, enable things that weren't possible before, allow that to get unlocked in fast ways. And then capital, I believe, follows that too, because that leads into insights, that leads into ability to execute in uncommon ways that others can't.
Well, I like the analogy that you said, that you mentioned, the holding it in the middle. So, Dana, given the velocity required in the VC ecosystem, how do you successfully manage the tensions between the deep, specialized market insight needed for seed stage investments and the institutional requirements to scale Greycroft into a resilient multi-fund platform?
Yeah, well, I mean, I think starting with scale and venture means something different than what it means, in some of these other areas. So, keeping in mind that what we are always looking for are really these just like incredible growth opportunities. I mean, if there's one thing that's constant in venture, it's that you want to be investing into growth. But beyond that, we're looking for technological cycles, and obviously we're in very early innings of a major super cycle with AI.
Correct.
But I've been doing this for quite a while. When I first started out in venture in Silicon Valley, the commercial internet was really just launching, and we were investing into the building blocks of sort of the commercial internet. And that's really where we are again today. It's sort of it's laying the groundwork again for this super cycle. one of my partners, who actually happens to be here in the room, has sort of coined this term that I love, which is it's the nomadic, thematic, generalist investors in growth. And that's sort of, for us, we're always, I think if you get too narrow, you'll be investing into, trying to find like the last kernel in a market cycle, maybe just because you're still saying I have to be investing in this, versus sort of stepping back and saying where is the growth. And so the approach that we've taken is to essentially build a platform that kind of has flexibility built into it, where we can have multiple strategies and allow each of those strategies to be operated by sort of small, nimble teams that can build the strategies in a way that make most sense for them, whether it's with great strategic partners, whether it's with, larger investors that we do creative, sort of partnerships with, but really just having a consistent culture around communication, around, really wanting to share information. I think that's where those unlocks happen, when it's sort of 1 and 1 is 3.
Well, that's a great perspective as well. And Jonathan, when it comes, so Kane International employs a highly specialized, vertically integrated model, blending the real estate equity and debt with strategic private equity and lifestyle brands. How does this high-touch integration provide a competitive advantage in securing differentiated deal flow and enhancing the asset value that a pure play manager cannot achieve?
Well, first, it's lovely to be here, and it's always great to be in Abu Dhabi and have the opportunity to enjoy the region. When we set up Kane about 10 years ago, myself with Todd Bowley and Tony Minella of Eldridge Industries, we tried to look at what we could do differently, because obviously, we were the young kid on the block and, competing against some very, very large companies in terms of the real estate angle. And over time, I think what we've learned and understood, in order to be differentiated, we need to have our own certain point of view and follow that point of view. And in terms of the high-end luxury real estate world that we've really, jumped a lot into, we've done that by coming at it both from the real estate angle, but also from the brand angle. So we were the first external investors into Oman. Mm-hmm. We invested in 2022, and followed by PIF and also various entities from Abu Dhabi, including Mubadala Capital. We own 1/3 of the Delano brand, as well as the real estate in Miami Beach, which we're bringing back to the market, refreshed and reinvigorated in March of 2026, in a few months' time. Mm-hmm. And what we have found is that gets us really close to the asset, and that we understand the dynamics of the industry as well as the underlying asset, which we think gives us a certain and a better perspective as to how to move forward and how to invest. And what that has led to now is a partnership with Mubadala Capital, which we're very excited and very proud of, because they see the world in a similar way. They invested in Oman just after us, and together we're developing a world of trying to get even deeper into this space. I think as you develop a business and you want to keep your people motivated, then you need to ensure that you've got a level of differentiation. So if you're investing in a certain space, you need to be really, really heavily invested in it. And that's what we've managed to do. And, we have a Six Senses product in Courchevel, we have Raffles in Boston, we have the Beverly Hilton, and obviously we're doing the very significant development in Beverly Hills, which is where the Milken Global Conference is held, where we're building an Oman hotel and 2 Oman residential towers, plus retail, etc. So that keeps us really close to the asset, as well as understanding the brands, and we believe that fusion is going to, is generating, will generate in the future, significant outsized returns for investors.
Well, you are located in interesting places and locations across the globe. So the second segment, so this is done with the first segment. The second segment will be on stewardship, governance, and organizational philosophy. And in this segment, I'll start with Dana, ladies first in this segment. So Dana, when investing in high growth, often culturally disruptive companies, how does Greycroft define and implement governance to ensure long-term value creation without inadvertently stifling entrepreneurial speed?
Yeah, I mean, I think one thing that's special about venture, and obviously I love it because I've been doing it for a very long time, is we're always minority investors, and so a lot of what we do is sort of around soft power, essentially, and really working closely with founders, developing, providing value all the time, being sort of that confident, that partner, and helping to build guardrails, but not being too stifling. And so, I think building great boards is really important. And I don't mean building huge boards. I mean building like great, small, where every single person is incredibly value add. And being able to do that in a way that then you sort of put the work in up front and get complete alignment. And then with like frequent revisiting of that so that you're not ever really out of it, because things do move so fast. I mean, every single any great company that anybody's seen in this world, and especially the high growth ones, have changed 10 times in the first 2 years. I mean, it's just, and especially now, that rate of change and velocity and ability to adapt is, you just sort of have to keep your board aligned. And I think, and your entire team. And so I think some of those things where people think about governance and think about things like that as being stifling, like you said, or like overstructured. But the reality is putting that work in up front, and it doesn't, it's just, and constantly actually allows for more flexibility and greater speed.
Mm-hmm. Of course, change is quick and we have to adapt. So, Guy, on this segment as well, so your stated focus on stewardship also involves ensuring investment teams are free of corporate constraints. How does Bridgepoint institutionalize this concept of autonomy, and what specific metrics or governance structures prevent the group management committee from overreaching into specialized investment decisions?
Well, I think there's two parts to your question. First of all, when we've thought about how we've grown our business inorganically, there's sort of been 4 key criteria that we have assessed new strategies, new businesses to bring into the group. The first is that they have to be genuinely complementary to and synergistic with the kind of existing activities and footprint of the firm. Secondly, they need to have a really good investment track record. I mean, that's an essential ingredient. Thirdly, we have to believe that, they can continue to grow under Bridgepoint ownership. And lastly, but definitely not least important, we have to believe that those businesses that we're bringing into the group have the same values that Bridgepoint does. And we're people businesses, so the value side of what we stand for is very important. In terms of the sort of governance side of it, as we've sort of expanded from 1 strategy into 3 strategies, what we've done is set up internally a board for each of the 3 strategies, and that board has responsibility for managing that business unit on a day-to-day basis. When it comes to investment committee decision-making, that is totally devolved into the leadership teams of each strategy, each product within each strategy. So the group doesn't interfere with that at all. Thirdly, we've then created these centers of excellence with group resource that the strategies can leverage off. And I think lastly, we've kind of very intentionally fostered a culture which acknowledges and even celebrates that the whole is worth more than the sum of the parts. So whilst what you're doing is very important in the bit of the business, the bit of the group at Bridgepoint you work for, actually there's something bigger going on here. And that's sort of resonated very well with colleagues. You asked me about our group management committee. Yes. That's what we call our senior management committee. That committee is there to make sure that those strategies, those business areas, have the resources and the support they need to do the best possible job for our investors in each of those product areas. They're not to make investment decisions. That's down in the product areas. Mm-hmm. And it's also there, that group management committee, to make sure that as we continue to expand the group, we're doing that in a way in which the senior leadership team believes is genuinely additive to what we already have. That's
interesting. David, on this specific segment as well, so the rewiring of the capital stack targets private wealth, often via structured products like the DSTs. How does Heinz manage the enhanced regulatory complexity, the investor communication overhead, and the liquidity demands associated with servicing over 170,000 retail investors, and what governance mechanisms, institutional standards are like ensured this way that you uphold across the investor base, the dispersed investors?
Yeah. So there's a couple parts to the question. I think that as this in part entails why scaling is going to be an important element, because servicing that number of investors and doing that really well with an institutional standard, requires a certain amount of back office ability and things like that. But it's interesting to see how things are getting disrupted. I mean, even today, with a lot of our institutional due diligence process, it's interesting to see how AI is already getting integrated in, and literally both organizations are just having their AI chatbots talk to each other, basically to share information. So the volume of requests have gone way up because AI has enabled that, but it's just everyone's just putting their AI together to get to the answers, if you will. But also there's a deeper thing happening, at least in our industry. So I'm obviously in real assets and real estate, which is very capital intensive, and it's been mostly historically designed around institutional investors. Because the checks have been very large to really be able to access it. So the whole system is mostly designed around the ability to write large checks and to be able to work that way. And this mega trend that we're observing is, private wealth is coming into that world in a big way. By most estimates, the private wealth world is significantly larger than the institutional world, but significantly underallocated to real estate. If institutional investors are 10 to 12% real estate, most private wealth investors are, maybe 5% at most. And so just going up a little bit of allocation is a lot of money. So that money is going to be coming into the system. But it's having difficulty accessing that system because it's mostly designed for a world that didn't include them. Because it's a world of mostly institutional investors that write large checks. So it's going to be an interesting evolution to see how this plays out, because I think there is going to be some of the I call it the legacy world needs to adapt and needs to figure out ways to make that world more accessible. That involves the capital wrappers, that involves the structures, that involves rethinking things that maybe were sacred cows to the industry. But also, I think the private wealth world is going to need to adapt as well and be thinking about how they access this asset class in a different way. So that'll be an interesting process to see play out. And I think there's going to be a lot of opportunity embedded in that, by the way, for those that can enable that. I think secondary market is going to be really interesting to see that evolve. That's going to provide a lot more liquidity. I think there's going to be a lot of governance evolution too in that. And so that whole story, I think, is going to be playing out the next 5 to 10 years.
Well, Jonathan, on this segment as well. So drawing on your prior roles, you had a leading major, like you led a major law firm and you served on numerous boards. Drawing on those roles, how have these experiences informed your philosophy of organizational stewardship at Kane, and specifically when it comes to the reputational capital and brand equity associated with the high-profile assets such as Amman or Chelsea?
For me, it's all about culture. Mm-hmm. I've been running businesses for almost 30 years now. So I ran a law firm for 10 years, which ended up having 500 people. We started off with 50 when I was running it. And we've built Kane over the last 10 years. And for me, the ultimate issue is reputation. Because to paraphrase Warren Buffett, you can make money, you can lose money, but you won't regain your reputation if you lose it. And I think the businesses that I've run, if I try to distill the principles or the cultural principles, it's about transparency, it's about empathy, and it's about the ability for the individual to maximize their potential. So just taking each one of those quickly. Transparency, both internally and externally, you have to be honest. You have to be straightforward, you have to be upward, sideways, honest with your partners, honest with your employees, honest with your counterparts, to ensure that you have a fair way of dealing and an appropriate way of dealing. Second thing, empathy. Mm-hmm. You can't spend your life bludgeoning your way through life. I just don't think that works. We talked about this before. You have to spend your life looking at it through the other person's point of view, through your counterpart's point of view. so that you try and resolve issues, because there are always issues to resolve every day in everything, and look at it from their perspective, because otherwise you just don't win. I always believe if you can create those partnerships, you will win more than you will lose. And the third thing for your people is you have to have an environment in which they believe they can maximize their potential. And you've created opportunities for yourself and for them to maximize their potential. I mean, I've spent my whole career wondering what that might be. I left the law because I wanted to see what it felt like playing in the Premier League, not with Chelsea, obviously, but in business sense. And I think that's a continual process that you have to have for your people. So if you can wrap that together in a culture of a business, I think you've got half a chance. And I think the only other point I'd make is that the last few years, certainly since COVID, with inflation and wars, etc., I think the need for individuals to have resilience and for a business to reflect and understand that resilience has never been more important.
Correct.
Because the shocks and stresses that we've all had to live through have been considerable. I always think sport is a great analogy. Roger Federer won only about 53% of the points in his entire career, even though he won countless majors and hundreds of tournaments. And as he said, you have to put the losses behind you and you have to carry on moving forward. And if a great sportsman like that only wins just over 1 in 2, that makes some of our percentages look okay.
Well, it's true. If anything, we have really learned across the past few years, it is resilient people and resilient economies are the ones that can stand up tall.
And it's why this place is so great, because it's got consistent leadership which understands its future and has that consistency and resilience which has taken it forward over the 50-odd years since the inception of the UAE, which is why it's so remarkable what's been achieved here.
Exactly. It is remarkable, honestly, not because we're here, but this is really my opinion about it. So, and I will go back in the end and ask you something about that honesty that you've mentioned, but to keep the conversation going, I'll go to segment 3 now, the part about innovation, technology, and platform evolution. So I'll start with Guy. We'll go back to the same seating arrangement. Guy, so Bridgepoint intends to leverage centers of excellence to ensure all parts of the group benefit from scale. Can you provide a tangible, non-financial example of how a centralized function delivers a material investment edge to a specific product line, such as infrastructure or small cap P?
Well, knowing I've got some colleagues from our corporate affairs team in the audience, I thought I'd give them a bit of a shout out in answer to this one. So our corporate affairs team is a group resource at Bridgepoint. It's obviously involved with communications generally and public affairs. It does a lot of work for Bridgepoint itself, but importantly, it does a lot of work supporting our portfolio, the companies that we're invested in. And a nice anecdote of this is a business called Humanetics, which is owned by one of our PE funds. It's a US headquartered business and one of the leaders in global automotive safety. So it's based just outside Detroit. And it designs and manufactures crash test dummies and their digital twins, which are used by automotive manufacturers and regulators right around the world. Now, for decades, regulators have only required manufacturers to test their cars and prototypes and new concepts with male dummies. And there is overwhelming evidence which shows that in the same car crash, a woman driver is 80% more likely than a man to suffer serious or catastrophic injuries. So our corporate affairs team has been working with Humanetics to bring much more focus on this topic within the US administration, as well as helping to sort of draw attention to it in a more public way through a media campaign. And literally in the last 2 weeks, NHTSA, which is the US regulator for the automotive industry, has announced new guidelines for manufacturers, which include female dummies for the first time. So that's a really nice example, because not only is there a great social good outcome from this, but actually, obviously, for humanetics, it opens up quite a big new addressable market. So there's a financial benefit for the company and therefore indirectly Bridgepoint and our investors in that fund.
That's a great anecdote here to signify this concept. So, David, so Heinz views the strategic importance of AI and data centers as critical enablers. Are the data centers now fundamentally viewed as core infrastructure? And how does AI influence real estate investment discipline beyond the data centers asset classes, in particular when it comes to predictive leasing, smart building governance, and operational efficiency?
Yes, there's a lot in that question. The first answer is yes. I do think data centers are now part of the infrastructure, and the way I think about it is, when you look back at the arc of history, certain inputs had disproportionate impact to the economy, right? So steel changed cities; we were able to go vertical. Electricity, changed time and how we work. And I think now compute is a new input into the economy that almost has a limitless demand. And the only constraint on that is going to be ourselves and what we can physically provide to access it and unlock it. So compute is this basic thing that it's going to have a very long tail. And so when you think about that dynamic and how it's going to change the economy, it's hard to kind of the analogy I've thought about is you think about what it must have been like in the 1800s. I think back to the U.S. in the 1800s when the rail, or in Europe when rail was being laid, and I've got to think, I just got to think back on that time, and probably not everybody understood then how important rail was going to be to driving the economy. And you can just imagine somebody in some Midwestern town, and this rail line shows up in town, and they just don't have any idea for what it's going to bring and how commerce is going to be driven on this rail. And so I think about the blind spots involved in that too, where this thing is happening that is a fundamental change of how an input into the economy. And new rail lines are getting laid all over the place. And we're probably underappreciating the importance of those rail lines and where they are, where they go, and what they're going to drive. And so that's this long tail of demand. Now within that, and probably what we're in right now is, there's going to be moments of speculative pricing and things that are going to get over its skis, and so how you navigate that is going to be critical. But this long tail of demand, I think, is undeniable. So when you think about these elements, the biggest thing in these big moments of change too, right? A lot of your own people within our own organizations, there's recency bias. There's all kinds of things that can impact how people are going to look at things and maybe get it wrong. And I know we're not all going to get it right, but I try to encourage people to be thinking in these historical lenses, because this to me feels like one of these historical pivots. And so we need to be looking at this under the arc of history, not just a cycle moment. So that's kind of broadly how we're interacting with the topic.
But just a quick comment on that. But don't you think that the change in this historical lens that you've mentioned wasn't as rapid as it is now? That the fear from all this really quick, rapid change can really cause this worry?
Yeah, I think, certainly you can feel the worry, and even sessions I've been in today at this conference, people are talking about what the impact we're already starting to see on jobs. And you have to believe, like every other significant thing that's happened, the economy reinvents itself and only grows in that. I believe that. But I do believe it can be a bit messy in that middle part as we go work through those elements of change. But I think having your eye on that North Star as an investor is critical, because at least in my business, it's our investments are long dated. When you make an investment in infrastructure or real assets, these are investments that are 7, 10, 15, 20 years. And so that's the lens I think you have to look at when evaluating opportunities.
Thank you for highlighting this. Dana, so from Greycroft's specialized venture perspective, how is the integration of AI and machine learning transforming the mechanics of a VC asset platform? And to be specific, from the sourcing deals and diligence to the accelerating portfolio company growth?
Yeah, I mean, from when I started in venture to today, I mean, it is such a dramatically different business. It's almost unrecognizable because, when really sort of in the late 90s, it was a very small group of people in Silicon Valley, largely. I mean, it had started to expand out, but it was really sort of still largely there. And it was a very, very clubby. It was a cottage industry. And it was about having these tight networks and exactly who you knew and being able to, sort of support companies in that way. Cut to today, there are, in the US alone, I think 3,500 companies a year that raise seed capital. And that's, somewhere in the single-digit millions of capital from venture capitalists. There are over 6,000 angel and seed funds globally. And as soon as a company raises any institutional capital, it's in a database. So the information is proliferated, and anybody who is in the venture business has access to that information. It's in, there's a number of databases, but, PitchBook and Crunchbase and Harmonic, and there's a new one that, gets launched every day that's doing something slightly better now with AI. And so it's no longer about like sort of that needle in a haystack, if you will, and just really, sort of knowing the person. It is then knowing what you're looking for in that sea of data and having sort of the patterns of understanding what makes somebody truly a great founder. And, I think that there's a lot, especially in today's environment, it's, oh my gosh, we've all heard it, 1,000 people that are, the top AI researchers in the world, and you have to be backing them or else which, is probably true. You probably want them involved, but that is not the sole input that makes a company that's resilient and, able to really sort of continue to expand as the market, changes. And so, sort of understanding what you're looking for. And then, every single investment that we make, we are competing fiercely to have the opportunity to either lead or participate in a round of funding. And so I think that's something that, again, these things always shift in cycles, but, gone are the days of, sort of the power being in the hands of the investors. It is very much for the top founders, they have their choice, and you have to be providing value. So then it's, what can you do in every single interaction with a team? And it's actually great. It's kind of, to your point about transparency and just being able to sort of reflect and be empathetic. Like, you have to provide value in every interaction, or you're not at the table. And so it is like it's sort of the truest test. Yeah, anyway, I'll be quiet because I can go on about this.
Yeah, competition is hard, but it is worth it, creating
it's definitely
value.
Worth it.
Yeah. So Jonathan, so your portfolio or the company's portfolio includes ultra-luxury assets, as we mentioned before, and more accessible brands such as Prezzo or Swingers. What flexible governance framework is required to manage performance and cultural consistency across such divergent operating models within a single investment platform?
Well, I'm sure it's a pretty similar approach to my colleagues up here, which is that you can't have a one-size-fits-all approach for every company. Mm-hmm. You have to, make your approach and your strategy fit that company. So if you take Aman, for example, Aman was obviously a company which had a settled philosophy. Everybody knew what the brand stood for, and Vlad Doronin, when he took over the company just 10, 12 years ago, he took it on a growth spurt and into urban cities away from the more resort-based, predominantly in Asia, that had existed before that. So our job there is to watch and to be a counterbalance and to be a debating point, but to let an experienced and very, very effective operator run that business. At the Delano, where we own a third, alongside the Ennismore group in our core, who we're very close with, have a great relationship, we feel more proprietorial, we feel more hands-on, because we're bringing the Miami Beach asset back to the marketplace in March of next year, as I may have said already. And therefore, we feel as if we're reinvigorating the brand and bringing the brand back to international prominence. And that has led to a number of management agreement arrangements around the world, including in Dubai on Blue Water Island. So, we're more active there. We're more involved there. In some of the other businesses, Prezzo, we bought the business effectively from insolvency from another private equity firm. We've been very hands-on in helping ensure the customer experience is right. I think everything that we've tried to do as a business across the variety of brands is to try and look at it through the eye of the customer. And often we're the customer, often so we know what we like. So we try and merge it to what we as a group might like. And in fact, we hired a really talented woman out of Wynn, who was head of consumer and customer experience at Wynn. Obviously, Vegas is probably the most globally famous, place in the world for consumer experiences, and Wynn is at the pinnacle of that. So we as a firm, we went out and hired someone who could teach us about how to look at it from a consumer's perspective and then build our brands and build our businesses around that. So, it's a variety of approaches, but all focused around the eyes of the consumer.
Perfect. So we've got 3.5 minutes remaining. So very briefly, with one sentence, Guy, looking ahead, what is the future of private equity given the ongoing volatility and the uncertain macroeconomic outlooks that we've got?
I think you'll see four things. More Europe, because there'll be more of I think there's already a better appreciation of the relevance of Europe in a global allocation sense. 10% of the world's population, quarter of the world's GDP. Secondly, I think you're going to see more middle market, because there's, again, more appreciation of the structural advantages of middle market versus large buyout, more value creation levers, bigger opportunity set, less reliant on leverage to drive return, not beholden to IPO as a method of exit. Thirdly, I think you're going to see more and more sector specialization just because of the ever-growing importance of really knowing your space inside out. And lastly, I think we're going to see more industry consolidation. And I hope Bridgepoint will carry on playing a part in that.
So I'll go with the same question to you, David, and maybe I would add just one little point as well. Given this outlook at this point, where do you see things going, and in the Middle East as well?
Yeah, look, I think the scarce resource, I think about what is the scarce resource, and in my industry, again, I think historically that scarce resource was capital, just because it's a very capital-intensive industry. Having capital ready to move quick was a differentiator. I think now it's much more about alpha generation, so that's a shift from beta to alpha. So I think that trend will continue, and that search for alpha is getting harder. I think that the other significant trend we're seeing is because of the capital markets environment, it's very difficult to build, and we're in a cycle that a lot does need to be built, but financially it's not the math doesn't work. There's not the premium that you'd expect, and so that's going to create pent up problems that I think that the investors are not fully understanding, because they forget how long it does take to build things. You just don't throw things up. I mean, there's zoning, planning, it's a whole process that takes time. And so that, I think, is going to end up driving rent growth and have other dynamics in the economy that I don't think we're fully appreciating right now.
So, Dana, on this point as well, amid this current outlook, what do you think is the most important fundamental element for the VC platforms in order to be able to stay resilient amid such a macroeconomic outlook that has a lot of question marks?
Yeah, I mean, I think one of the biggest things is sort of rethinking, in some ways, the relationship with LPs and with partners, is really thinking strategically. And how can you partner in order to deliver a huge amount of value, like true value, not hand-wavy value. And I mean, one thing that just rings true, and I know we're counting down, but at a breakfast yesterday, Mike Milken said that, in this region, the cost of power is 1 cent per, megawatt, what is it, kilowatt? Now I'm going to get it all wrong, sorry. But compared to in California, where it's 30 to 40 cents. And it hit me in such a meaningful way. It's obvious we talk about it all the time, but when you think about that as an input and how that can really fundamentally change things, and when people, our portfolio companies and other technology companies think about this region and what that can mean for them as far as differentiation and moving fast and being sort of an early adopter. I mean, it's a huge opportunity. And so I think for funds like us to help our companies be thinking very strategically and then partnering with people that can help them execute on that.
Perfect. And one last remark. So in such an environment, and I will go back to the point of honesty that you mentioned, in such an environment with macroeconomic uncertainty, a lot of competition, trying to reap the opportunities, is honesty appreciated?
Well, I think ultimately investors are looking for return. But I think if you go on that journey with honesty and transparency and you deliver that return, that creates a distinctive relationship between your investor base, which ensures that you can see yourself through rocky periods, because no one gets it right all the time, and no one has a seamless journey from A to B. So in order to have that depth of relationship with your partners, it means it gives you an ability to see yourself through areas. David said, he's investing for periods of 7 to 10 years. No one has a crystal ball. No one can predict the future. And if you look back over the last 7 to 10 years, wow, we've lived through that period. And none of us could have predicted the way it went. So I think the important thing is to have that value-based system in your firm, in your organization, and project that and repeatedly tell your people the same things. And I'm sorry if they get bored hearing it from me all the time, but I am saying the same things time and time again, because I think if you get those principles through, then those principles will be reflected in your people. And in that, I think you'll make better investors and you'll make better returns.
Well, that's a great closing remark here. So let me thank you again for participating in this panel. Guy Weldon from Bridgepoint Group, Dana Settle from Greycroft, David Steinbach from Heinz, and Jonathan Goldstein from Kane International. Thank you, everybody and everyone, for being here today. It was a great conversation.
Thank you.
Thank you.